Okay, welcome everybody. We are going to learn today from Noah Wertheimer from Noah David Financial LLC. You might have recognized his picture and name from our event down at Meeting of the Minds. He is part of the Coastal Insurance Consulting Group, which also is where I work and some of the time. So certainly check us out. He will be later joined by Elijah Davis. He is a partnership advocate with Urban Catalyst Funds, and he is located in San Jose. So we have a number of members out there in San Jose, but I know that Elijah does work nationally as well. So with that, I will hand it off to Noah.
Thanks, Dan. So like Dan mentioned, my background is in wealth management. I've been doing it for almost 18 years now. I started in the corporate world at JP Morgan and was there for about 13 years. So my specialty really is in holistic wealth management. And what I wanted to talk about specifically today was really your after exit wealth strategies. And in a way, we always talk about, well, if you're planning after you exit, that's probably too late to plan. So really, you want to make sure that ultimately you have a plan in place. And, I know I'm talking to a lot of business owners, right? So each one of you have taken a tremendous amount of time to build a business plan for yourselves. And probably review that at least quarterly, if not more than that, just to make sure you're continuing to really stay in line with your goals and objectives. So I always like to say, a good financial plan starts from the day that you start your business. I'm a small business owner myself, and so I know some of the difficulties of that, some of the challenges that come across it. I also know of, the free Fidelity or Schwab or generic financial planning tools that you can use. Not to say that they're bad, but they're very generic and they really don't assist in ultimately creating the true wealth strategy that you need. So, when it comes to financial planning, I think one of the most important parts is really to plan effectively. And a lot of times you'll see a financial plan where they'll say, hey, here's your retirement goal of $120,000 a year. Well, what does that mean? Where is that $120,000 a year going? So really breaking that down into priority goals, whether it's taking vacations, buying a second home, taking your grandkids' college tuition into consideration. So many different types of goals. So really building a plan based on those priorities and then stress testing them. So a lot of times, especially now with what you're seeing in the economy, there's some stress around what's happening with inflation and it's impacting your portfolios. So looking at how do we stress test based on previous history. We look at the Great Depression and how that might have impacted your goals. We look at this last Great Recession that we had, we look at the same thing. So really working together to do that and then investing wisely based on those, right? So there's always a recommendation, but then how you implement that is not just all at once. You don't just say, here's my plan, and then on day one, you got everything going. It really is taking the time and implementing that strategy and then monitoring it and updating it. I see so many times a really great financial plan, and then 12 months later, it's the exact same thing, or 2 years later, it's the exact same thing. And as you know, in a business plan, that's not how it works, right? You have a business plan that guides you, but it's certainly not going to look exactly the same, especially in this market that we're in. So really making sure that you're implementing a strategy to monitor and update those goals. One of the ways to do that, I think, is really building on relationships through your CPA, your estate planning attorney, and your financial advisor. So I like to really partner with a group or a team, so you have almost like a one-stop shop. So at Noah David Financial, I do have partners as CPAs and estate planning attorneys. I know, Dan, that you utilize that as well quite often. And so really making sure that when you're going through this financial planning, you are involving everybody. It's not just the advisor, but it really is an entire team of people looking at your plan and making sure that it does make sense. So one of the things I wanted to kind of hit on today, and we had talked about this about a month ago, is premium financing. This is a great tool. Again, this is more of a pre-planning exit rather than a post-planning exit strategy. But one of the ways to really improve your ability to reach your goals in retirement is through life insurance. Dan, I know, has spoken with many of you and has actually created some plans for a lot of you in regards to this. It's one of the best ways to really create a tax-free retirement. It's probably not talked about as much as it should, especially within the small business community. Part of it is because a lot of people will hear insurance and they back off, especially because you're dealing with all kinds of insurance when it comes to your business, right? So this is just a small case study that I wanted to show you. It's actually based on a client that we did business with about a year ago. And so, typical business owner, 57-year-old male, standard health. And what we ended up doing was we looked at what his goal was in retirement and really how can we create that income stream, especially from a tax-free retirement. So you can kind of see at the very bottom, his potential retirement income, his target was about 130 grand. We built a plan that paid him 133,000 a year, age 67 to age 100, all tax-free. And we backed into that plan by saying, okay, if you have that specific amount that you require for retirement, what is that going to cost you up front? So you can see the contribution on his life insurance policy was only for the first 5 years at $125,000 a year. So he put in $625,000. The premium financing case. So what happens is there is a financier who will then go through this whole case study with this male. They'll look at his income and his expenses. They'll look at, his tax returns. They'll look at his P&L. And based on that, they felt comfortable giving him a loan of $277,000 a year for 10 years. So they actually contribute $2.77 million to this life insurance policy. Mr. Client has only put in $625,000. Everyone goes, well, how in the world do they do that? These are built on illustrations, and so that at the end of the 10-year period, there is a payoff from the lender, so they will receive compensation based on the rate that they've charged and from the cash value of that life insurance policy. Even after that's done, from a pretty conservative standpoint, Mr. Client basically puts in $625,000. If he lives till age 100, that's a $4.4 million return on his investment. So great way to really look at a potential tax savings, but also a way to create your own retirement strategy without having to go into the market necessarily. So you're limiting some of your risk that's put before you. And again, like I mentioned, Dan is excellent with these plans. We support at Coastal Insurance, we support Dan in that role. So we can certainly build plans for you based on that. The other piece I think that's looked over quite a bit is tax advantage strategies, especially when you're looking at selling your business. Most of you, if not all of you, will have some sort of capital gain, whether it's small or big, it's going to be there. Probably most of you, it's going to be pretty large, especially if you've depreciated assets or you have other assets that have grown in your working years. So one that you're probably very familiar with is a 1031 exchange. 1031 exchange is real estate, right? And so one of the things that we want to make sure you understand with real estate is making sure that if you are interested in selling, but you're not necessarily wanting to sell everything lump sum, it's a great idea to actually separate the property from the business. And then you can actually 1031 that property to something else, whether it's another commercial property, maybe it's a rental home in the Florida Keys, wherever it is. That is an opportunity. One of the caveats with that is you've got to pre-plan, right? So you can't just do the sale of everything or the sale of your property and then go, oh, actually, I want to do a 1031. It's got to be pre-planned before you actually sell the property. There is one fairly new tax advantage strategy called the Qualified Opportunity Zone. Some of you may or may not be familiar with it. This one actually is eligible even after capital gains have been taken. So it's a fairly new IRS ruling that came down the pipe in 2017, and it gives you 180 days from the date of your capital gain to actually reinvest those capital gains. And it defers your taxes as well as gives you opportunity for tax-free growth long-term. So I wanted to bring in my partner, Elijah, to kind of highlight that qualified opportunity zone. He's going to speak specifically on one, but really just give a better understanding and a more in-depth dive into that. So Elijah, are you available?
I am. Yeah.
Awesome.
Thank you, Noah, for the introduction. And Dan, thank you for having me on. It's good to see you again. Hope you had a nice Thanksgiving.
Yep.
So I assume I have the capability to share my screen. Is that accurate?
Yes, you should.
Beautiful. Okay. So let me go ahead and do that. Everybody see my screen okay? Beautiful. Awesome. So my name's Elijah Davis, and I'm with Urban Catalyst. Urban Catalyst is a ground up real estate developer located in Silicon Valley, specifically San Jose. It's important to note we're a developer first and a fund manager second. And we've been doing ground up development in San Jose and Silicon Valley for a decade and a half, specifically 18 years, with much success. And so Noah invited me to jump on here and kind of talk about our specific QOF offering that we have. And I'll go into depth on, why San Jose, obviously Urban Catalyst, but talk about our Fund 2 offering and talk about some of the Qualified Opportunity Zone legislation. So we've had about $10 billion of experience in development and acquisition, specifically in San Jose. And I'll talk to you about, again, why San Jose and a bit about our Qualified Opportunity Zone. Before I do that, like all investments, we have our risks, and we encourage you to read through our private placement memorandum in great detail before ever making a decision to invest with us. Our main risk with Urban Catalyst is illiquidity. This is an illiquid investment. It's an alternative investment structured for accredited investors, so high net worth investors. A little bit about opportunity zones. So like Noah mentioned, back in 2017, as part of the Tax and Job Cuts Act that Congress passed, it enacted 8,700 opportunity zones all across the country. These zones were designed for areas of economic distress, and this is a way for developers to come in and provide revitalization in these areas. And I have to be candid and mention that all opportunity zones are not created equal. They're not all located in Silicon Valley. Fortunately for us here at Urban Catalyst, we're in one of the fastest growing recession resilient markets in the country. In order to invest into an opportunity zone and receive the IRS tax benefits associated with opportunity zones, it has to come from capital gains. And those are capital gains that are realized and invested within 180 days of the time that you realized your capital gain. Now, at Urban Catalyst, there are several capital gains that we all are aware of, but the most traditional capital gains events that have happened here at Urban Catalyst and been invested into our Fund 1 and Fund 2 programs are from the sale of real estate, the sale of business, but about 70% have come from the sale of stock. Now, the current market environment's a bit different. So sale of business and sale of real estate has been the most common over, let's say, the past 6 months or so. A lot of people are sitting on a big position of Apple that they bought 10 or 15 years ago. They want to carve it off, protect the downside, and invest it into a tax-advantaged investment offering like a qualified opportunity zone. So the two main tax benefits associated with all opportunity zones, whether it's Urban Catalyst or another sponsor, is the ability to invest today and defer your capital gains tax until 2026, payable in 2027. So you still have to pay your federal capital gains on that capital, on the realized gain portion, but it's deferred out till 2027. The other is if you invest today and you let your funds season into an opportunity zone for a period of 10 years, and this is per the IRS, you can take part in tax-free growth federally, meaning you don't have to pay federal capital gains tax on the back end based on the growth of the investment. There's some other tax benefits that I'll mention later, but for sake of the conversation, these are the two main tax benefits. So a little bit about San Jose. This is a map of downtown San Jose in the current opportunity zone. This black line, it shows the current opportunity zone in San Jose. And what you'll notice at a glance is you'll see, Zoom's global headquarters is inside the opportunity zone. Adobe's global headquarters as well. But we also have 2/3 of San Jose State University inside the opportunity zone, made up of 35,000 students. And then this red line is East Santa Clara Boulevard, and it's the main thoroughfare, the main drag in San Jose. And the red line really shows Santa Clara, but also the Bay Area Rapid Transit line it's been approved and will be expanding into downtown San Jose. So that's huge for commerce and activity in San Jose. And it'll have two entrances. One of those entrances will be a half city block from our future Fund 2 site, very relevant to our current projects. And the last thing I'll mention on this slide is, you see over here on the left, this is Google's future mega campus. They just acquired 80 acres last year, and they're going to build over the next 5 to 7 years their largest campus in the world. And San Jose is very pro-growth, and they want to see, they have a housing shortage. They want to see that this campus integrated with the city of San Jose. So it'll be an open campus, unlike the Mountain View campus that's kind of a closed off fortress, if you will. Part of that campus is inside the opportunity zone. Again, very relevant and positive for our future projects. This is a map of the Bay Area, and Silicon Valley really starts from Palo Alto down to San Jose. And there's a bit of land constriction happening in Silicon Valley, meaning most of these areas in Silicon Valley are fully built out from a commercial standpoint. Between Facebook, Google, and Apple, they own more than 65% of the office space in Palo Alto, Mountain View, and Sunnyvale. So the majority of the activity is moving down into San Jose. So if you want to build development from a mass scale, it's likely going to happen in San Jose. You can't build over here in this gray area. This is conservation land. It'll never be built on. Can't build in the water. And over here to the west is the same story. Will never be built on. So all that activity is moving into San Jose, and it's a very competitive market from a real estate standpoint. So just kind of fast track. We already talked about Adobe, Google, and Zoom being inside the opportunity zone, and the Bay Area Rapid Transit, the largest mass transit system in Northern California, what they're doing with their expansion line in San Jose. But again, in order to build development at a mass scale, you have to have support of the city. And we have just that. This picture here on the left is our CEO, Eric Hayden, our COO, Josh Burrows, and the mayor, Sam Liccardo. They have a standing meeting with him once a month, but our development team, they're meeting with him and his team on a weekly basis on some of the projects that we have in the pre-construction phase, projects that are currently being built. That we have the support of the city, and it's very important for us to get our projects approved and move forward. So I mentioned a little bit about Urban Catalyst earlier, but Urban Catalyst, we're not trying to be all things, all people, and build in different markets in the country. This is a market where we understand. We've been doing development again for 18 years, and we have $5 billion in development projects and another $5.2 billion in real estate acquisition, specifically in this market. Our development team is made out of a team of 25, managing each one of our assets that we're currently working on, and it helps us drive them forward and maximize not only the tax benefits, but the profits for our investors. A little bit about our track record. These two slides that I'm shifting between here were bought and they were sold between a 3 to 6 year window. That's traditional for ground up development. With our current fund, Fund 2, Qualified Opportunity Zone Fund, we've structured it for a mid-teens IRR, 15% per year, but you'll notice some of these projects have IRRs between 39 and 72%. So past performance is obviously no guarantee for future success, but the way we've structured our fund and the conservative underwriting, we feel confident that we can achieve that 15% IRR per year, federally tax-free. Urban Catalyst is made up of 5 partners. The 3 gentlemen on the left, Eric Hayden and Josh Burrows, you saw them in the picture earlier, and Paul Rigg. They head up our development team and manage our 25 developers and project managers on each one of our projects. Sean Raft over here on the right side, he's got a very extensive background as a lawyer in LA. He's also our chief administrative officer and general counsel. He wrote the PPM. He really dots the I's and crosses the T's here for Urban Catalyst. And then Morgan Mackles. He's part of our 506 team, 506C team, our direct capital raise channel, and he heads up that organization. We've been featured in several news articles over the past few years. Forbes magazine recognized Urban Catalyst as one of the top 20 developers, OZ developers in the country. I'm very proud of that. And just a little bit about our past success. So we were formed in 2018 around the Tax and Job Cuts Act and the QOZ legislation. We launched our first fund in 2018. We closed that fund at the end of 2020, December 31st of 2020. It was a $105 million offering. And it was so popular, we oversubscribed by $26 million, raising $131 million. And that's made up of 6 properties that you'll see here. These 6 properties were all approved for building. We had all of our building permits in under 18 months, and that's record time, really. The one I want to highlight, this is a closed offering, by the way, is the Paseo project. The Paseo project is roughly 100,000 square feet of mixed-use office and retail. We broke ground on that last year, and we have a completion date of Q1 of next year. The first 25,000 square feet of retail is already leased with 3 tenants. So we're very proud of that. Moving forward, we've already broke ground on Timber, Fountain Alley, and Delmas. So that project is moving forward nicely. So before I go on to our Fund 2 offering, are there any questions that I might be able to address? Just relative to the QOZ legislation, capital gains, San Jose?
No, I just, real quick, Charlie, I don't know if you have anything, or Lance or Steve, anybody who's on the call. Otherwise, we can keep going.
Beautiful. So as we keep moving on, this is that map that I showed you earlier, downtown San Jose. Those 6 properties I just showed you in the previous slide are here in the blue legions. That Paseo project is right here, just a few blocks from our Fund 2 site. And I mentioned that Bay Area Rapid Transit line being approved and getting ready to break ground. They're going to have a substation with 2 entrances built 45 feet under the ground. One of those entrances will be a half city block from our future Fund 2 site. The Fund 2 project is currently open. I'll get into that here in just a moment. But why is that relevant? Well, today, as it stands, folks up in Walnut Creek or East Bay or in San Francisco, they can't get down into San Jose and work their day without, driving part of the way, hopping on the train, taking it to Zero station over here, and then Ubering. It's not fluid as it stands today. But when this is complete, folks can hop on the train, get down into San Jose, work their day, hop off the train, go to work, and do the same to get home each day. And here are the two projects in our Fund 2 portfolio. We have right here in the front corner, this is Icon. Icon is will be a 511,000 square foot Class A office building designed for a single tech user. At build out, we feel confident there are 30 to 40 tech tenants that can take down this size square footage in a 15-year net lease. And that's what we intend to do with this asset. And right behind it is Echo. At completion, Echo will be a 389 unit apartment building, also Class A. With 1 to 2 bedroom apartments, entry-level apartments will be roughly 650 square feet. And we've underwritten them for $2,500 a month. Right across the street, this is not an asset in the portfolio, but it's another apartment building that just completed in Q1 of this year, and they're leasing roughly 30 to 35 units a month today. And their entry-level apartments are going for $3,200 a month. So we like to think that we underwrote conservatively, and we'll be able to achieve the underwriting that we've set for it. There we go. Here's some of the renderings of both buildings. You can kind of see this is a blend of the office and apartments. We built the office with 15-foot high floor-to-floor heights, open office feeling, designing it for a tech company so they come in and really customize it to their liking. Both buildings will have HVAC systems, touchless elevators, considering the current environment we just came out of. Let's move on to our timeline slide. This is really the cash flow model and how we underwrote the investment. Again, the investment is, it was launched in March of last year. It's a $200 million offering, and we've raised right under $120 million in equity today. We're going to raise equity through the end of 2023, so roughly a 3-year capital raise. We have the ability to raise in excess of 200 million. It's looking like we're going to achieve that. But minimum investment on this program is $100,000. Unit price is $10, and it will remain $10 during the entire hold period. But this is how our program is structured. We're going to break ground on both projects mid next year. So let's call it June of next year. We're going to build through 2026, completing the projects in 2026. When we have the projects completed, we're going to take both buildings to the bank for a structured refinance. Our goal is to return up to 65% return of capital in 2026. Why are we doing that? We're doing that so clients and investors can pay their taxes in 2027. So we use a hypothetical $1 million capital gain investment, which we have seen at 65%, you're going to get a $650,000 return of capital in 2026. At the highest tax bracket, remember we talked about that deferral of capital gains. The highest tax bracket, your capital gains bill would be $238,000 on a hypothetical $1 million investment. So if we return $650,000, you're going to have some excess capital after you pay your taxes. So you pay your taxes in 2027. Now that both buildings are built, they're stabilized, they're cash flowing. Between 2027 and 2033, the remainder of the hold period, our goal is to return between 2% and 4% a year, return of capital, non-taxable event, each year of the remainder of the hold period. And then per the IRS, again, with opportunity zones, it's a 10-year hold. So again, 2024 to 2034. As close to January 1 in a day, we're eligible to sell both buildings. When we sell both buildings, we've underwritten again for a 15% IRR per year, federally tax free. That equates to a 3x federally tax-free, but the assets are located in California, and California is a non-conforming state. So you do have to pay California state tax on the back end. What does that do to your IRR? It reduces your IRR from a 15% federal tax-free to roughly a 14.2 after paying the state of California. So a 3x to a 2.8x. I like to think that's still an attractive return, a strong tax play. But there are also some additional tax benefits that I'll mention quickly. We've structured 3 additional tax benefits with our program that a lot of other qualified opportunity zone funds do not have. And that is each year of the hold period, 2024 through 2033, you'll receive a K-1 for tax reporting. On that K-1, due to it being a ground up development project, your K-1 will show a loss. So you can take the losses each year of this program and offset any other passive gains or passive income that you have. So if you have an investment property, you can take the losses from this program and offset the losses with your passive real estate investment that you own. The other is, due to us being a multi-layered LLC structured in a qualified opportunity zone, there will be no depreciation recapture. So that's the second additional tax benefit. And then the third is any unused passive losses throughout the hold period can be carried forward when we sell in 2034 to offset any passive income that you may have in that respective year. So that's the third additional benefit. So as we move on, we incentivize early investment into our program through what we call our bonus units program. It was so popular in our first fund, we decided, hey, we're going to bring this into the second offering, and investors seem to really like it. The first one is our time incentive credit. You'll see here, December of 2022. If you invest in December, you're going to get an automatic 3% worth of units off the top. So what does that mean? Every $100 invested, you're going to receive $103. And then we have a multiple ventures program. That's for folks who invested in fund 1 and want to take part in fund 2. They get an extra 4.5%. But our volume incentive program, again, our minimum investment is $100,000, but starting at $300,000 and incrementally each $100,000 above that, goes up 50 basis points. But you, at $300,000, you'd get an additional 1%. So you would add that 1%. If you invested in December of 2022, you'd get the 3%, so 4% right on the top. That could drastically impact your back-end IRR and gives you more unit ownership right off the top. So let's just recap what I've talked about. Again, our Fund 2 offering launched in March of last year. It's a $200 million offering. We've raised right under $120 million. Minimum investment is $100,000. It's designed for accredited investors only. And we issue the K-1 for tax reporting. Our management fee is 2%, but what's unique with Urban Catalyst, and I haven't seen this at any other alternative investment sponsors that I've represented, is in year 8 of the hold period, we start to decrease our management fee by 25 basis points annually to a minimum of 50 basis points. And we're doing that to align ourselves with our investors and really do what we say we're going to do when we say we're going to do it. So our 3 goals are to return a full principal return, full return of capital. You begin to start accruing a 6% annualized preferred return each year of the hold period starting in 2024. And then any remaining profits are split 80 to the investor and 20 to the sponsor. So I'm happy to answer any questions. Noah, again, thank you for having me. Dan, thank you for having me as well. I appreciate it. Are there any questions that I might be able to address on our program or opportunities?
I have a question. So I work with a lot of business owners, and some of those owners have multiple owners in their business, S corps and some C corps, and so they create quite a bit of cash if they sell part of the assets, if not all the assets in the business for whatever reason. as an accredited investor, can organizations like that participate in something like this, or is it strictly the individual?
Yes, it generally would come from an individual who owns an S corp or an entity,
Okay.
and it really comes down to when there's some workarounds as far as that 180 days goes. So let's say you sold your business in June of 2022, but your CPA didn't claim that sale until that taxable year, until December 31st of that year. So it would be 180 days from the date that the CPA claims that the sale of the business.
Got it. Okay,
But,
because
generally it's an individual owns the entity.
yeah, so you had recalled, like when we were down in Arizona, there were a number of owners who had sold previously. So they had sold within a matter of 6 months. So all of those individuals have the ability to participate.
Correct. If they're
Okay.
within their 180-day window.
I will definitely send them the video then.
Fantastic. And I can make this presentation is client approved.
Okay.
And it can be shared with clients without a pre-existing relationship due to it being structured as a 506c.
Okay. Thank you.
You're welcome.
Anyone
And
else?
One really quick comment.
Yeah.
Too, just for everyone that will listen to this. Elijah, as I mentioned, is a great partner, and not to take away from anything that Urban Catalyst does, but there are other opportunity zones available as well.
Mm-hmm.
So it's one of those things where I wanted to highlight this one specifically because I do think it's a great opportunity, but there are other ones as well that we can discuss, whether it's, if somebody doesn't want to worry about the California tax implication, or we actually just added one on the platform that is actually oil and gas. So it has nothing to do with real estate, but it has everything to do with oil and gas. So there's great opportunities. It's a pun, right? There's great opportunities in the opportunity zones. So I just wanted to make sure everybody did understand that.
Excellent.
Yeah, I have a quick question. This is Lance.
Hi.
In the case where private equity comes in and takes a majority share of a company, are those funds eligible for the 1031 exchange, or because the owner still retains stock, are they ineligible?
Did you want to take that one?
Well, actually, I was going to fumble first through it. So my understanding is your question is revolving around the fact that an individual may have sold 70% of his entity and retained 30% of the entity, which means that he has to recognize the proceeds of the sale, which would, to me, typically indicate that he would be considered an accredited investor. I mean, what do you think, you guys?
Yeah, I think in that hypothetical that you just provided, Dan, I think that's accurate to say if there was an actual realized portion of the sale that would essentially need taxes paid on it, that would be a recognized capital gain, and the portion that's still held up would be considered an unrealized gain.
Correct. So if they structure the deal where it's over time, there is a change of shares, then it's different. But in most of these buyouts we're seeing right now in the industries that we work, there's a recognition at the moment of sale, whether you got the money or not, the sale's taking place. And which means then you have the ability to then reinvest that 1031.
Well, so really quick, the question, Lance, you said, are you talking about the 1031 or are you talking about the opportunity zone? Because those are two different.
It's true.
Well, let's answer them both. First, the 1031, would the funds be eligible for that? And then is there any impediment into going into the opportunity zone with those funds?
So I'll comment on it, and then Elijah, if you want to kind of fill in the gaps. But with the 1031, there is an intermediary that must be assigned, and they actually hold the funds that will be then used to reinvest. So if it's already done, then there's really no way to do a 1031. That is one of the big differences between the 1031 and then the opportunity zone. However, in an opportunity zone fund, you do not have to use capital gains. You could potentially just use the proceeds from the sale of that property and invest in that qualified opportunity zone. Elijah, the one question I have for you would be, if that's the case, obviously we don't defer the capital gain because there isn't one to defer. Well, let's say there's not one to defer. Do they still get the secondary benefit, which would be that tax-free growth?
So they essentially, if you put in non-capital gains dollars into an opportunity zone, which we've seen happen on several occasions, it's treated as a private real estate deal. And you would not receive the IRS tax benefits associated with opportunity zones. However, you would still get the benefits of the program. The return of capital in 2026, the incremental income along the way, and then the overall growth of the real estate projects on the back end. But you would still have to pay federal tax on the back end and state tax. So you're treating it as a private real estate deal. Does that answer your question?
Yes. Lance, does that help clarify?
Yes, very much. Thank you.
Anything else? If not, again, we appreciate you guys running through this material yet again for us. And, there were a number of people who missed it the first go around. That will not happen again. So we'll be pushing this out to our different peer groups. Right now, as you know, we have 18 groups, 10 owners in every group. So hopefully that continues to expand this year going into 2023. But we appreciate you guys. And again, thank you so much, Noah, for bringing this topic to our attention.
Thanks again for your time.
And Elijah, thank you.
Really
Thank you
quick,
for
if
having me.
anybody needs to reach out to me directly, you can always call me. 720-505-6851 is my direct line.
Got it. Okay. And we'll be giving both your contact information with this video. So we appreciate it.
Excellent.
Awesome.
Thank you so
All right,
much.
take care, guys. Thank you, Lauren, for putting this together. Great. Thanks.
Thank you.